All right, 107 students, we are continuing with our discussion of forms of business organization. In Chapter 7, we looked at sole proprietorships and partnerships, and now we're going to get into corporations, a very, very popular, well-used method of shifting risk from the owners of a business to a separate legal entity, which is exactly what a corporation is. It is a separate legal entity formed on the basis of provisions in a statute. In the province of British Columbia, it's the BC Business Corporations Act that allows for this. We're going to get through some terminology, and then we'll get into the whole concept of limited liability, which is one of the key reasons for using the corporation form of business organization. All right, corporation versus company. A corporation is definitely a business that has been incorporated under the BC Business Corporations Act, or in the other province under whatever statutes they have. Company, we have to be a little careful of, because it may be a corporation. For example, the Hudson's Bay Company is obviously a corporation. On the other hand, ABC Manufacturing might be either a sole proprietorship or a partnership. The only way you can be for certain is to do a corporate search with the registry in Victoria to find out if a company is actually in fact incorporated. Private corporation versus public corporation. Private corporation has less than 49 shareholders, and its shares are restricted as far as the sales go. In a public corporation, the shares have to be publicly traded. Okay, private corporations generally small, but not necessarily so. Public corporations generally larger, not necessarily so. Shareholder versus member. We used to have a Company Act under which we would incorporate a business. That stems right from old English law, mid-1800s. And in that statute, shareholders were referred to as members, okay? Members who hold shares in a company. Up until 2003, in the province of British Columbia, you were considered to be a member of a corporation, but we modernized our statute in that year, formed the BC Business Corporation Act, which repealed the Company Act, and bingo, you're now called shareholders. Okay, there are other jurisdictions where you still run into the term member, and for example, if you incorporate a not necessarily a society, but a cooperative, your ownership in the cooperative, you're called a member. Shares versus stock. You hold shares in a corporation, you hold stock in a corporation. They are synonymous. Stock is generally an American affectation, whereas we refer to it as shares in the United Kingdom and Canada. There's federal jurisdiction and provincial jurisdiction, so you can actually incorporate a company in 11 different jurisdictions in the province, or in the country of Canada. When would you use a federal corporation versus a BC corporation? It comes back to what you're doing. If you're incorporating a bank, you have to go under the federal jurisdiction. If you are incorporating an insurance company, same thing. An airline, same thing. Because the statutes, the federal statutes, govern those entities. If you're forming a business to run a restaurant, a manufacturing process, a multitude of other businesses, you would generally incorporate under the BC Business Corporations Act. A few years ago, two students came up to me and they said they and their fathers, the four of them, were going to form a new corporation which would have the next as successful as McDonald's franchise operation. Tons of tofu. No, I'm only kidding. I cannot say what their name was because I'm not sure where they are in the process. Anyway, they had the two young lads had their incorporation documents prepared, and they said, "Would you mind looking at them?" So I looked at them and I said, "Okay, you're incorporating federally. Why?" And they said, "Well, we want to operate all across Canada, and so we'll incorporate there rather than incorporate in each province." And I said, "No, I don't think you can do that. You certainly could incorporate federally, but you would spend all that money incorporating federally, and then before you could operate in the province of British Columbia, you would have to extra-provincially incorporate your company here, which means going through two incorporations with double the expense. And they said, oh, but that's terrible, because then they would have to extra-provincially incorporate their BC company in Alberta and Saskatchewan and Manitoba and Ontario and so on. And I said, why? And they said, because we want to have franchises all across the country. And I said, no. I said, think this through. Your business is located, head office, in BC. You incorporate here. Somebody in Alberta wants to buy a franchise from you. They have to incorporate in Alberta. You don't have to incorporate in Alberta. You have a contract. Contracts don't pay much attention to borders. So you'd incorporate once in the province of British Columbia, and then all the other businesses incorporate under the appropriate statute for them. Okay. On the other hand, if you wanted to run an airline, like my client up north, Hans, they have their lodge, hotel, tourism business incorporated under a BC statute. And then he has an airline because he has 3 planes and he flies people around the province to hike and hunt and fish and things like that. So he incorporated the lodge under BC law, and he incorporated his airline company under federal law, the federal statute. Okay, so that's how those two things work. The next slide that we're going to look at is slide 174, and it just talks about corporate social responsibility. There's actually classes that you can take, a course called Corporate Social Responsibility. And for me, it's a bit of a soft topic. Not an easy course, but a soft topic, in the sense that we will learn that corporations do not have a soul. They are formed by statute, and so they have less feelings for the fate of their workers. And so consequently, in modern times, we've been looking at what social responsibility does a corporation have. And it really breaks down to who you're serving. So the 174 diagram shows the corporation in the middle, shareholders, obviously one of your stakeholders, okay? Means a person that is affected by your corporation. Then there's suppliers, you have contracts with them, they're a stakeholder. There's the government, you pay taxes from them, they regulate you, they're a stakeholder. Then there's the environment, and this is our duty, which is becoming more and more evident in keeping our planet habitable, all right? So, how can the corporation have a small footprint? How can they be more green? How can they help the environment rather than hinder the environment? And then their customers, obviously, they're a stakeholder in your company. They either buy your products or they use your services, and they have an interest in the good governance of your business. Employees, again, obviously, stakeholders. They get paid by you. They get health benefits from you, perhaps. You direct their work, and so there's a tremendous relationship there. However, when in my international trade law class, I have one group work on whether or not a business in BC should actually outsource the making of their products to another country. And this brings up, from a financial point of view, it makes a lot of sense. The labor in Mexico is way less expensive than in Canada. Fiberglass is available at a lower price given the exchange rate on the dollar, so we can save on supplies, we can save on labor. And it's almost a no-brainer until you throw in this concept of social responsibility. What about the employees in Canada that you have to lay off in order to produce your product in Mexico? What about the government that's now going to get less taxes? What about your customers? How will they feel about suddenly the product is no longer Canadian made, it's made in Mexico? It's good for the shareholders. They get a larger return on their shares, on their investment rather. And the suppliers in Canada, they're hurt. Well, you can say, okay, but we're generating employment and generating contracts for suppliers in Mexico, which is, sort of balances that off, perhaps. And so I had another group look at the corporate social responsibility. Well, the difficulty with comparing that is the the dollars can be worked out almost precisely. The cost in the corporate social responsibility is very, very difficult, if not impossible, to calculate. So corporate social responsibility is something that businesses have to keep in the back of their mind because customers and the governments are looking for a better treatment by the corporations than in the past. But it's still a very, very tough area to quantify. All right. The next slide talks about the internal workings of the corporation. You have shareholders that elect directors that appoint officers, and the role of the directors, the board of directors in a corporation, is set out in Section 136 of the BC Business Corporation Act, which is in the materials which you can refer to during the exam if necessary. That section says the director's responsibilities are to manage and supervise the management of the business and the affairs of the company. What? Business and affairs? I guess that's just the government being wordy, right? Use two words when one would do. No, there's actually a tremendous distinction between the business of a company and the affairs of the company. The business of the company is what you do to make a dollar. What goods you sell, what supplies you provide, what services you give. The affairs of the company has nothing to do with chasing your secretary around the desk, which is no longer allowed anymore, thank goodness, under the Human Rights Code. What affairs of the company means is keeping the company in good standing. Now, there's a term that I'm lecturing with, and you have to know, although I'm not certain it's in my slides. Good standing. What does that mean? A company has to be kept in good standing with the Register of Companies in Victoria, which means that they have to file an annual report, not financial statements necessarily, an annual report, and they have to have a meeting of the shareholders in which the shareholders then also appoint the directors, and then there must be a meeting of the directors to appoint the officers of the company. If dividends are declared, there has to be a resolution in the corporate minute book, which says that the certain amount of money is dispersed by way of dividends. That begs the question: what is the corporate minute book? Well, the corporate minute book is nothing other than a black binder in which there's sections for resolutions of the directors and officers, resolutions of the shareholders, share certificates, and copies of the Shareholders Agreement and other things like that. Okay, so that's the corporate minute book, and you make sure those things are done, you're in good standing. What happens if you're not in good standing? Well, I got a client quite a number of years ago now because that client was not in good standing for a series of 3 years, and his company was struck off the register, which means it no longer exists. He wasn't a small business person. This was a person who acted as an angel. Okay, one of those people that brings businesses together with investors. And he also invested in businesses himself, and he had this corporation that he worked through, and he was putting a deal together one time, and he was going to take an equity position in a business, and he was going to do it through his company. And the lawyer for the business called him up and said, "You can't do that because your company doesn't exist." And the fellow said, "Well, yes, I've been using it for years." Well, he had moved numerous times, and you always send out changes of address to everybody but the corporate registry because they just wouldn't dawn on you, right? So he, the next year, the Registrar of Companies sends out a notice, time to file your annual report. It gets returned, okay? Sends it out the next year, time to file your annual report. It gets returned. The third year, the registrar sends out a notice saying, if you do not respond within a certain period of time, your company will be dissolved. That's what happened. He didn't even know about it. So I got the client because I could then reinstate his company on the proviso that during the period that it was struck off the register, if somebody else grabs the name, too bad, you're out of luck. If there's some problems tax-wise, too bad, you're out of luck. But we could reinstate it, which we managed to do, and then he's been my client for years. So you have to keep your company in good standing and make sure that the documents are filed in the minute book so that you have a record that this has been done. So that's the affairs of the company. Now, the thing to remember here is that isn't a duty of the director. Okay, this is just a section that sets out what the directors are supposed to do. Okay, the duties of the directors are their obligations under the Corporations Act, and we'll get into that a little later on. Okay. The next slide, however, slide 176, is one of the most important slides in the whole course, and that shows the advantages of a corporation in that it provides you limited liability. Okay. This is a big advantage over sole proprietorships and partnerships. The diagram shows a corporation and it shows 4 shareholders. It could be 5 shareholders, it could be 1 shareholder, it could be 18 shareholders. It doesn't matter. And then it shows the directors being elected by the shareholders, and then it shows the officers being appointed by the directors. What provides this concept of limited liability, which means as a sole proprietorship, I have unlimited liability. I'm liable for everything. As a partner, I am even in a worse position because I am jointly liable for debts and obligations, and I am joint and severally liable for tortious activities of my partners. Not so with a corporation. You have limited liability, which means there's this barrier between the shareholders and the directors and the officers and the corporations. It's called a corporate veil. Okay, back in the late 1800s, a lord in the House of Lords in England said that there's this barrier of protection, and it's likened to a corporate veil. Okay, and that term is stuck ever since. So we have this veil of protection. Well, it's extremely obvious, or very obvious anyway, how there's this barrier between the shareholders and the corporation. In Section 30 of the BC Business Corporations Act, it says the corporation is a separate legal entity having all the powers and capacities of a person of natural capacity, or a natural person of full capacity, which means all the powers and capacities of me, okay? And then Section 87 says the shareholders are not responsible for the debts and obligations of the corporation other than the fact of their investment. So I invest $2,000 in Exxon, big corporation that's in the fuel exploration business. They have another Valdez spill. Quite a few years ago now, they had a Valdez spill in Alaska when a drunk captain at command of a tanker, an oil tanker, ran aground, and hundreds of thousands of gallons of oil spilt into the pristine Alaskan environment. It cost $5 billion to clean up. Exxon spent $4 billion, and then they said, that's it, we're not doing it anymore. So the government of Alaska paid the other billion. Billion? I can't quite remember whether it was million or billion. $5 million. I think it was million. $5 million in cleanup. Exxon does 4, and they say, that's it, we're not going to do any more. And the government of Alaska paid for the other million. No, they didn't. The citizens of Alaska paid. They pay the taxes to the government. The government doesn't have any money. Okay, so anyway, they clean it up. But if they had another Valdez spill, and those tankers, it was a single-hull tanker, okay, and that was one of the problems. But now they use double-hull tankers, don't they? No, they don't. They're still using single hull tankers. So, and they come right down the what they call Johnson Strait between Vancouver Island and BC. If there's a spill there, it would be another multi-million-dollar cleanup. And Exxon, it must have been billion, because Exxon was on the verge of insolvency almost with the cost of the cleanup. So they have another spill like that. Exxon goes insolvent, and there's billions of dollars to be paid. So they're not going to come and knock on my door and say, "Hi, Peter Holden, you have $2,000 of shares in Exxon, which means you hold 1% of the company's shareholdings, which means your proportionate share of the cleanup is only $5 million." What? Okay, no, it doesn't happen, because I don't have any obligation for the debts or tortious actions of the company. It's a separate legal entity. But I lose my investment. So I lose the $2,000, but it ends there. Corporations were structured like that in the mid-1800s just for that purpose, to get people to feel better about investing in a corporation, knowing that they could make big returns on the investment, but if something went wrong, they would only lose the amount of their investment. Okay, so that's how shareholders are protected. Corporations would not be the significant risk management tool that they are if it only protected shareholders. Because for us, we'll probably have private corporations. And if a private corporation only protected us as a shareholder, but didn't protect us as a director and officer, then there would literally be no reason to incorporate a company. So what protects directors and officers? What makes that veil of protection not only protect the shareholders, but continue to go up that diagram and protect the directors and officers? It's agency law. Okay? So on the exam, final exam, if that's on there, that is going to be one of the key factors. All right? What protects the shareholders? Section 30 and Section 87 of the BC Business Corporations Act. What protects directors and officers? Agency law. How does that work? I have given you the definition of corporate veil on slide 177, and it gives you Section 30 and Section 87 there. It's also in the corporate materials that are in the lecture materials, and it talks about agency law extending that protection up there. Okay, so we'll come back and talk about agency law protection in a minute, but we've talked about one of the advantages of incorporating over sole proprietorships and partnerships: unlimited liability. That's the key advantage. There are others, though. Continued existence. For example, the Hudson's Bay Company was formed in 1640. Okay? I will bet you $10 right now that there is no natural shareholder, original shareholder, alive today. Obviously, in 1640, that's 400 years ago. So shareholders die, but the corporation goes on, because the Hudson's Bay Company was incorporated in 1640. It's still here today. Back then, it was called the Company of Adventurers and Explorers. It's undergone a name change, and it's undergone a total change in what it does as a corporation, but it is still in existence. There's a corporation in Japan that has just done a business plan. Well, about 20 years ago, they did a business plan for the next 500 years. Pardon me, that cannot be serious. 40 years ago, we couldn't imagine the existence of the internet and personal computers. So how do you know what's going to be here for 500 years? It's like totally stupid. But anyway, they did. So corporations continue to exist even though the shareholders pass away. The shares are passed down in their estate to their children and their children's children, and so on and so on. Separation of ownership and management. A few years ago, my wife said, "Peter, can I take $5,000 and play on the stock exchange. Well, we could afford to lose $500, and so I said, sure. And so she bought some what they call blue chip stocks, and then she bought some riskier stocks. And she lost on the riskier stocks, but she's making a little bit of money on the blue chip stocks. What blue chip stocks? Banks, okay? Now, I hate banks. I mean, they charge us for giving them our money. They charge us for holding our money, and then they charge us when we want to get our money back. I mean, what kind of a great gig is that? I wish I could be a bank, okay, but I don't like dealing with banks. Anyway, she figured that, they're good at raping and pillaging, so why not buy some shares? So she bought some shares in Bank of Nova Scotia, and she bought some shares in TD. Not very many, but she was just learning the stock exchange, right? And so she bought those. Now, what does my wife know about running a bank? Pretty much nothing, okay? But she doesn't have to, because there's a separation of ownership and management. All she knows is there's this board of directors that are making massive profits, okay? And so she is going to vote her shares to keep them there because they know what they're doing. So there's a separation of ownership and management. Ease of sale of her interest. If you have a private corporation, she would have to go to the directors and say, may I sell my shares? And for some reason, they may say no. And we'll get into that a little later on. But in a public corporation, if the shares are publicly traded and they're supposed to be, she just goes down and sells her shares. So ease of sale of your business interest. If it's a private corporation, you want to sell it. It's still easier than selling a partnership. Partnerships have contingent liabilities, okay? Whereas you can sell your shares in the company and the person can buy the corporation, and then it's a lot easier to facilitate. No loyalty or duty of good faith by the shareholders. Every year, my wife gets a notice that she should go back to Toronto and vote her shares. Now, she doesn't have enough shares that she's making enough money that she could afford to fly to Toronto, stay in a hotel, and eat meals, and then go in and vote her shares. So she just doesn't go. Oh, breaching her duty and loyalty of good faith? No. You have no obligation whatsoever. What the secretary of the company does is, and this isn't like a office secretary, this is president and secretary, and believe me, I'd like to be the secretary of Exxon for a day. Okay, he probably makes $5 or $6 million a year, so divide, 365 into that, and hopefully what could go wrong in a day, except maybe another voltage spill. But so anyway, that's the secretary, and he sends out a notice and he says, we're having a shareholders meeting. You can come and vote if you want. If you don't, then you can send me a proxy saying how you want to vote. Do you want to vote for this board of directors? Do you want to approve the financial statements? And that secretary will then take your proxy and vote for you. Okay. So technically, the secretary could collect proxies from everybody and have a meeting with himself, being the only person there, because he would have a quorum. So no loyalty or duty of good faith. And then the next advantage is the possibility of tax advantage. Now, I say possibility. Once you start making over $100,000 a year, you're paying a huge amount of taxes. So there is a possibility, and here's where you talk to an accountant, that you could actually take less in wages and give yourself dividends. Take less in wages, your taxable rate goes way down, and then your dividends are taxed at what? Well, effectively something like 14%. Okay, so if you give yourself a salary of $200,000, you're going to pay about 60% taxes. But give yourself a salary of $80,000, you're going to pay about, 35%. Okay, and then take the rest as dividends and pay 18%, and you'll save money. Okay, so those are the advantages. There are some disadvantages, and I'm just going to take a short break here so that we can have a coffee if we want, and then I'm going to come back and talk about the disadvantages. All right, now I've had my cup of coffee. We can get back at it. at the end of the previous segment, we were talking about the advantages of the business corporation form of business organization, and now we're going to talk about the disadvantages. And quite frankly, there are two listed in the slides, and neither of them are particularly disadvantageous. The first is the cost of incorporation. You can actually spend maybe a couple $100 less having a partnership, and maybe another $100 less to have a sole proprietorship. But as far as the cost of investing in a business operation or establishing a business operation, the cost of incorporation is not that significant. I routinely incorporated companies for $1,200 to $1,300 for clients, and that gave them a multitude of different types of shares, okay? So it wasn't just a basic incorporation. So in the overall picture, $1,300 is not terribly significant. Add to that about $1,500 to $2,000 for a shareholders agreement, which you want to have, and we'll get into that later on. And you're looking at maybe $2,500, $2,000, maybe $3,000. So that money should be set aside to incorporate the company and get a shareholders agreement, because that will be a good investment in the long run. The cost of incorporation becomes incredibly significant if you decide to go public. I don't do this kind of work, and so I could be a little off base, but I understand that it's somewhere between $500,000 and $600,000 of investment, seed capital, necessary to get listed on the stock exchange. Very few of us can afford to do that, because you need promoters to do that, and then it becomes significantly dangerous in the sense that you're giving up a lot of control of your company in order to get on the stock exchange. Then the cost is really significant, okay? But for a private corporation, insignificant. Regulatory requirements. Again, if you're listed on the stock exchange, you have regulatory requirements right up to here. Financial statements, initial public offerings, the whole 9 yards. But if you have a private corporation, the regulatory requirements on a yearly basis to keep your company in good standing is not significant. Companies were paying me $285 plus taxes, and I would make sure that their annual report was filed with the Registrar of Companies. I would do the consent resolutions of the shareholders, the consent resolutions of the directors, and keep you in good standing. So not terribly significant. Let's see. I think that's it. Now, one of the problems, well, we can get into that later on. Let's go to agency law, which is the slide 180. And agency law is what protects directors and officers. So it's pretty straightforward how the shareholders are protected. We don't have to talk about that too much. But the agency one is the one where you have to do a little bit of work, okay, in order to maintain your protection. Agency is a relationship where a principal authorizes an agent to enter the principal into contracts with third parties. On slide 180, you see the principal has this contract with an agent where he pays the agent's costs and commission, and then that agent enters the principal into a contract with a third party. What's that mean? Well, give you an example of agency not related to an incorporation, because you have agents everywhere. Okay. There was a nurse in the interior of British Columbia at a hospital where they specialized in dealing with Alzheimer's patients. And she looked at an Alzheimer's patient having an episode, okay? And that's when all of a sudden you don't know who you are, you don't know where you are, and you don't know what's happening. Okay, it's just got to be terrifying. And Alzheimer's eventually, over many, many, many years, your brain forgets to breathe and you die. Okay. But in the early years, it's just this episode. And she likened it to being a baby. Okay. A little baby sitting in a carriage. Doesn't know who he or she is, doesn't know why they're there or what's happening. What happens when a baby cries? Ah! You give him a stuffy, and he calms down. So the nurse thought, okay, if an Alzheimer's patient has this episode, the danger is that they have a heart attack because they're so stressed out. Oh my God, I don't know what's going on. They have a heart attack. And so what the nurse said was we have to calm them down. So an Alzheimer's patient starts having an episode, they would give them a stuffy. And that would help calm them down. So she started doing that, and she had tremendous success. All of a sudden, nurses and doctors all around the province are saying, oh, that's fantastic. Send us some of your stuffies. We'll buy them. I pretty much think any stuffy would do. But, hey, she realized she had a business opportunity. So now she wants to make these dolls, these stuffy dolls. And she finds out in the province of British Columbia, wages are so high that nobody's going to spend $100, $150 to get one of her stuffies when they could go down to Walmart and buy one for like $9. So she realizes she has to have them made less expensively. She knows that that can be done in the Far East. Well, the funny thing about the Far East is you go west to get there. Okay, so I'm being a little facetious, but what it means is she doesn't understand how to go to China or Vietnam and have these dolls made. And so she hired an agent. Well, coincidentally, I had a student go through the International Business Program at Capilano University, and he came out the other side and he graduated, and he came into my office and he gave me a cup of coffee and a donut, and he said, Peter, tell me how I can get involved in international business when I have no money to invest and I'm up to my eyeballs in student debt. And I said, Vince, it's easy. You can afford to get business cards made, get them made, and put agent under your name. Then schmooze at board of directors, board of trade meetings, chamber of commerce meetings, seminars, all those sorts of things, and circulate and give your cards out. And somebody will hire you as an agent. They will pay you costs and commissions, and they will send you somewhere to have product made. Okay? And so he said, oh, okay, and he did that. And he met this nurse, and she hired him as her agent to go to Hong Kong and find a manufacturer to make her dolls for her. Vince is back in my office, gives me a coffee and gives me a donut. And he says, okay, Peter, tell me how I do that. And I said, okay, Vince, this is easy. All right. I said, what you do is you buy a ticket, you fly to Hong Kong, get out of the plane at the airport, get into a cab, say, take me to the Canadian consulate. Now, they all speak English. So they'll drive you to the Canadian consulate. You walk in and you talk to a Canadian trade officer and you say, I need these dolls made. Can you please direct me to some manufacturers? They will take you to a couple of manufacturers, and you can then make a choice of which one you want to use. Then he did that, and he entered his nurse client into a contract with the manufacturer to make the dolls. The dolls would be delivered, and he would make a certain commission on each doll. I get a call from him in Hong Kong, and he says, Peter, he said, I'm an international agent. I am phoning to thank you very much. I'm in the hotel right now, and I've been paid to come here, and now I'm schmoozing people over here and handing out my business cards. Bingo. International business agent. Well, that's the agency relationship. He enters the nurse into a contract with a manufacturer in Hong Kong to have the dolls made. If the dolls are defective, who does she sue? She cannot sue Vince because he didn't make the dolls. So you look at the diagram on page 180 and you look for the contractual arrangement. it's between the nurse and the manufacturer, so she has to sue the manufacturer, not Vince. What happens if the dolls are delivered and they're okay, but the nurse fails to fails to pay? Who does the manufacturer in Hong Kong sue? Look at the diagram again. The contract is between the manufacturer and the nurse, so he sues the nurse. Cannot sue Vince because of a thing called Privity of Contract. Okay, now look that up in the textbook because it is a term which you should know. It's not on my slides. I usually write it on the board, and I tell my students anything I write on the board, it could wind up on the exam. I cannot write it on the board. I guess I could behind me if I had a board, but I don't, so I'm pretending to write it. Privity of Contract. You have to know that. Privity of Contract means you can only sue parties that are parties to the contract. Okay? Cannot sue Vince because he is not privity. He has no privity of contract. Okay, now that's a really good advantage because he can function as an international agent. He gets paid his costs plus a commission, and he can have almost no liability. The only time that he could be in trouble is if somehow he exceeds his authority. Okay, but you get a letter of authorization from your principal that allows you the authority to enter into the contract. You're not signing the contract yourself, you're signing it on behalf of your principal. Okay, now this is important because this is what protects directors and officers in a corporation. So let's turn it into a corporate scenario. The next slide, 181, shows the principal being the corporation. The agent is the president or vice president or secretary or vice president in charge of sales or whatever, okay? And the president of the company brings the company into contracts with a third party. So again, the company, the corporation can be sued, but the president, agent, cannot be sued. Oh, good. It is on the next slide. I couldn't remember. Privity of contracts. Okay, only parties to a contract have the right to an obligation under the contract, including the right to sue or be sued. Okay, so how do you indicate that you're an agent if you're the president of the company? Back to that signature line that I talked about in the very first class and talked about when we were reviewing the contract assignment. If it's Peak Performance Pontoons, using the scenario in the textbook, Benton Counter, the president of the company, would sign underneath the name of the corporation, put per in front of his name, which stands for on behalf of. So in the document, you would not see the thing in quotes on behalf of. Okay, you just put Peak Performance Pontoons, Inc., per. Benton Counter signs that document, and then underneath, in the world, according to Peter Holden, put authorized signatory, because that is one more way to signify or signal to the judge that you are signing not personally. Okay, you're authorized signatory. Are you the authorized signatory for you? No, you're not. You're you. So if you're an authorized signatory, it must be for someone or something else, i.e. the corporation. So that's one of the ways that you can, through risk management, make sure that you have the limited liability protection of a corporation. The other thing you have to do is you have to do your due diligence. Okay, so we'll get into that. But then signing appropriately as part of the due diligence. All right, continuing with the nuts and bolts of the corporation, how do you incorporate a company? Under the BC Business Corporations Act, there's 5 steps involved in it. You need a name reservation. You want to be called Peak Performance Pontoons, Inc., so you fill out a form and you send it into the government, and the registrar says yes. No one else has a name similar to that, so you're entitled to use it. If Peak Performance Pontoons, Inc. was gone, you might be able to say Performance Pontoons Manufacturing Inc., which would be acceptable. And so what you do is you pay $35 and you file and you get a name reservation. But if that name is not available, you pay another $35 and try to find another name. And if that name isn't available, you pay another $35. You don't have to pay $35. What you do is when you file your name application, you can list 3 names in the alternative. Peak Performance Pontoons is what I want. But if that's not available, Pontoons Manufacturing Inc. will be acceptable, and if that's not available, then PPP Manufacturing Inc. Okay, so you do that. You get your name reservation, and now you have 56 days. I don't know why 56. Like, why not 60? Why not 50? But anyway, 56 days to file your incorporation documents. So the first thing you do is you fill out an incorporation agreement, which does not go anywhere, doesn't go to the registrar, doesn't go anywhere except into your corporate minute book. Okay, and that's just a document that says I wish to be formed into a corporation with the name of whatever you got your name reservation. Then you have to adopt articles. There are standard articles prepared by the Register of Companies that most companies use. The difficulty with that is it's on the presumption that the decisions of the board of directors will be by unanimous, not by majority. So if there's one director and you're the sole director of the company, no problem. If there's 2 directors, then you have a potential problem of a deadlock. Okay. If there's 3 directors, good. There cannot be a deadlock. Yes, there can. 1 for, 1 against, 1 abstention, just like in my partnership fiasco. And again, you have a deadlock. So you can draft your own articles using basically the ones from the Register of Companies, and then at the end change that to say that in the event of a tie, the chairman of the board shall have the deciding vote or whatever. Okay, so you can change them to fit your scenario. Okay, then you send in your incorporation application, pardon me, which just lists the name of the corporation, your reservation number for your name, who the directors are, who the officers are, how many of the shares are going to be, and who gets the shares initially. Bingo, bango, bong. You're incorporated. And there is a danger here, because if you go onto the government site, they are very helpful. You can do that yourself. Wow, why do we need a lawyer? Ha! Let's save the legal fees, right? These guys get paid too much money anyway. I have nothing to gain by this because I've retired, but listen to this. Get a lawyer. If you do it yourself, at least have a lawyer review the documents. Preferably get the lawyer to do it. If there's a screw up, the nice thing is you get to sue your lawyer for screwing up. If you do it and you screw up, who do you sue? Well, you sue yourself. Yeah, okay? So, and the pitfall here is if you go into incorporate a company, the first 4 steps is what you do for the registrar. The 5th step, they don't do. The 5th step, quite often, the person incorporating the company doesn't do either because they don't know about it. My clients, the husband and wife, baker, manager, 2 restaurant clients, pardon me, incorporated, okay? They did it themselves. They didn't need a lawyer. They're operating for a while, and the Canada Revenue Agency knocks on the door, walks in, sits down with Pamela and says, "Hi, I understand you have an incorporated business." And she says, "Yes, I do." And he says, "May I please see the minute book?" And she goes, "I don't know what that is." "Well, that's a document, the binder where all your documents are kept." "Oh, I don't have a book, but I've got my documents in a file. Here's my certificate of incorporation." And he looks at it and he says, "Oh, okay, that's good. Now let's see your constituting documents." She goes, "I don't know what those are." Okay, that's what the Register of Companies doesn't do for you. Once you incorporate your company, you are halfway there. Now you have to have a resolution of the shareholders, okay, appointing the directors. Then you have to have a resolution of the directors appointing the officers. The shareholders all have to sign applications or subscriptions for shares, and then all the directors have to sign consents to act as director forms. If those documents are not there, your company is not constituted. Okay. Now, the Canada Revenue Agency said to Pamela that she would be taxed on a personal basis if the company did not have constituting documents. And he was very kind. He said, I'll come back next week and you can show them to me. So she contacted the lawyer referral service. They contacted me. I went in and I did the constituting documents for her. Okay, and then bingo, she was okay. And that's how I got Pamela and Chris as clients. But the constituting documents have to be done. Okay, slide 184, risk management, shareholder agreement. And this talks about the contents of a shareholders agreement. We'll come back to why these are all in there, but you have to have rights to management, which means the shareholders appoint themselves as directors. Okay, right to employment, which means that as directors they can appoint themselves to be officers. There has to be a default provision in case somebody doesn't pull their weight, and then there has to be a right to sell shares with a corporation or with a corresponding right of first refusal, which means I'm in a corporation and I don't like what's going on. I can sell my shares if I can find a buyer, but I cannot just sell them. I have to find the buyer, and then the existing shareholders have the first chance to buy my shares rather than having to work with somebody else. Okay. Key life insurance, key person life insurance, key person disability insurance, an absolute must, and we'll explain why later. And then there should be a share valuation mechanism, because what's going to happen is one of the shareholders is going to pass away. And if you have the shareholders agreement, then the existing shareholders get to buy the shares from the estate of the deceased person, and that estate is required to sell the shares back. Okay, if I had shares in Microsoft or Apple or Starbucks, and I passed away, my wife would probably want to keep those shares. Microsoft, Apple, or Starbucks might want to buy them back. Okay, they cannot buy them back unless there's a shareholders agreement which says I must sell them back. Okay, and the corporation may not have the money to do that, but if one of the key people dies, then the insurance pays the money to the corporation. Now the corporation has the money to pay the estate. How do you know what the shares are worth? So you have to have some sort of share valuation process. Should be a confidentiality clause, of course, because there will be proprietary information that you want to save. There should be a non-compete clause, because the last thing you do is want to get some shareholders together, appoint yourselves directors, appoint yourselves as officers. Somebody learns the whole system and then leaves and competes against you. And then last but not least is the clause that should be in all contracts, and there should be a mediation or arbitration clause. Don't use a precedent. One size does not fit all. I actually had a client come in one time and he said, we've got a shareholders agreement. And I went halfway through and I said, it talks about manufacturing a product, but you provide consulting services. And they went, oh, well, yeah, I mean, we just, got this off the internet. And there were some other problems with it. Mark your copies of the shareholder agreement for confidentiality purposes, because if somebody breaches that clause about confidentiality or non-disclosure, how do you figure out who it was? Well, sometimes you can do it because they wind up using the agreement, and then you can funnel through and figure out who it was. And then make sure that the shareholders agreements are signed under seal. Okay, remember my close friend who had that shareholders agreement and signed under seal? Well, that story has another whole aspect to it. He was the same person that entered into the cruise ship franchising operation as a partnership. I drafted a partnership agreement, and he didn't get around to signing it. His partner didn't get around to sign it. he does the extra work and then doesn't get to keep the money, has to split it, because under the Partnership Act, you split profits equally unless you have a contract, a partnership agreement, which circumvents the Partnership Act. Same thing with the corporation. So he starts off as a partnership with this person, has that difficulty about the partnership agreement, and then once they've sort of worked that out and they're, back and friendly again and they're continuing operating, making lots of money, the accountant comes to them and says, you should incorporate because now you are making so much money that you should incorporate, because then you can pay yourself dividends and reduce the taxes. Okay. So they come to me and they say, all right, we're incorporating a company. Would you do that for me? And I say, yes. And they say, is there anything else we need? And I say, yes. A shareholders agreement. So I prepare a shareholders agreement and I send it to them. Do they sign it? No. They're far too busy doing this, far too busy doing that. They'll get around to it, no problem. Well, it didn't turn out to be this profit dividing mechanism anymore. It was another problem. And that is, my client of the two, my friend, has worked in this and he's worked in this and he's made lots of money and he worked in this and now he wants to semi-retire. So he wants to continue just working as an employee with the company, and he wants to sell his shares. So he goes and he finds a shareholder, a potential shareholder, and he goes to his business associate, the woman, and he says, here's Frank Smith, I'm going to sell my shares to him. And because he really wants to invest, and he really wants to get involved in the business. And she says, oh, I don't think so. He can invest, he can buy shares, but no, you're not selling your shares. And Cam said, well, no, I want to sell my shares. And she says, but we were going to sign this shareholders agreement that says we have the right to sell shares with a corresponding right of first refusal, which means you could have said, I'm going to sell it to Frank Smith, and then she would have the chance to buy them first so that she didn't have to work with Frank Smith. But she said, well, I don't want to do that. I don't, he can invest in the business and he can become a director and an officer, the whole 9 yards, but you're not selling your shares. And he said, well, we'll see about that. And he calls me up and he says, Peter, I'm going to sell the shares. And I said, well, you didn't sign the shareholders agreement, so you don't have this provision that allows you to. And in your incorporating documents, it says, as all companies must have, if they're a private corporation, a restriction on the sale of shares, and the two of you agreed that the shareholders agreement would vary that provision which said the directors have to agree. Two directors, him, her, he wants to sell, she doesn't want him to sell. Stalemate. Okay? So the bottom line here is, if you have a partnership arrangement, one of the best risk management tools you can have is a partnership agreement. It may be flawed, there may be problems, but at least you have attempted and have ironed out most of the potential problems. If you have a corporation, you want to have a shareholders agreement for exactly the same reason. All right? So don't use a precedent, code your copies for confidentiality purposes, and execute the agreement under seal. Real seals, the red ones, not little pictures of harbor seals. Okay? Okay. Some nuts and bolts of the corporation. This is some terminology that you will need in future courses in the department. Debt versus equity. If you lend money to a corporation, this is called a debt. You get paid back your principal plus interest, and the interest is how you get your return on the investment. If you invest in a company, you may want to take bonds, which is security against fixed assets that the company owns. That's security for your debt. Equity, you have a greater chance of getting a higher return on investment, but you do not have the protection of being able to take bonds as security. Okay? In the corporation, you own shares. They can be broken down into common shares and preferred shares, and there's this distinction between authorized capital and issued and paid up capital. Common shares are the voting shares. Preferred shares are when there's an investor who wants to invest in the company, get a higher rate of return, but does not want to be involved in the operation. And so you can have common shares only, or you can have common shares and preferred shares. All right? And I think we're going to take a break here because I think I hear the dinner bell going off, which means supper is ready, and I am going to stop and pick it up there later. Thank you very much.